Hello from Washington DC, I'm Jim Levis from M&G. I'm here for an IMF conference about global debt. The questions are, how do you know a country is going to default on its debt? What happens to it when it does default, and how can we prevent it in the first place? So it's 10 years after the Lehman crisis, the great financial crisis, and while we've seen some stabilisation in debt to GDP levels in developed markets, and I guess the US might be one exception to that, emerging markets have seen a big rise in their debt to GDP ratios. There had previously been a kind of poster child for good low levels of debt to GDP. But one thing that might surprise you is that sovereign debt, when we think about that, debt to GDP ratios aren't all that useful in predicting who's going to go bust. If we look back at the 40 or so sovereign defaults over the past years since World War II, there's a full range from 8% debt to GDP to 150 plus debt to GDP at which the sovereign has gone bust. So it's not on its own good enough to tell us whether an economy is in big trouble. And of course we have the fantastic example right now of Japan with a debt to GDP ratio of 235 or so percent and still going strong. Reinhardt and Rogoff were both at the conference over the past couple of days. Their famous book, This Time Is Different, I mean, you could argue it propelled austerity into the forefront of people's minds, and you can argue whether that was the right thing. I think probably it wasn't in response to the great financial crisis. The other thing about This Time Is Different is a lot of the arithmetic in it has come under question. There were problems with the Excel spreadsheet that they used, but nevertheless the 90% debt to GDP level they talk about is quite important in the literature nowadays, and they did make it clear at the conference that they don't regard that as a threshold that's the be-all or end-all of all of these things. They talk about it in the same way as the example they used, an NBA basketball player. There aren't many 5'11" basketball players in the NBA. Once you get above 6 foot, they're all above 6 foot. But obviously being over 6 foot is not the be-all and end-all to being a top basketball player, but it is an important signifier of what you need to do to make that sort of grade. So, I mean, the US is arguably above that level now, the UK's close, France, Germany, we talked about Japan already being way above it. So, you know, it is something that is a little bit important to us, and with the US having its tax cuts and ageing and Medicare, Medicaid, all of these sorts of things, that debt to GDP level is just going to get bigger and bigger in the future. Now, the conference also debated what is debt, what do we count in that, and do we take enough notice of the other side of the equation, the assets? I mean, Norway's the great example, debt to GDP ratio of 35%, but actually the asset side on its sovereign wealth fund, the oil money, is 300% of GDP, so a huge counter to that debt it has in the balance sheet. Also, many ways of counting debt. You'll all know the debt clock in Times Square. I think that has US debt at something like 21 trillion US dollars, but some estimates, even official estimates, range from 15 trillion, and the most extreme unofficial estimates, depending on what you count, you know, do you count GSE guarantees, do you count pension fund liabilities, etc., come up with a level that's maybe 210 trillion. So that's just in developed worlds. Do you count pension fund liabilities and things like that? When you come to emerging market, things get even more murky, and they estimate that maybe a third of state guarantees are never publicly declared by emerging market economies. And that's important if you come down to an insolvency or a bankruptcy. Not that you have bankruptcies in sovereigns, which is something we'll come on and talk about, but nevertheless important. And you throw China into the mix. China has been lending, especially to lower income emerging markets, quite heavily. And a lot of that is guaranteed, a lot of it is senior in some way, and a lot of it is collateralized, maybe with port or something like that, and it doesn't appear in the official figures. So how should we as investors and we as economists think about some of that hidden debt when it comes to calculating whether a country can repay its debt? Now, the conference also talked about what you do when you end up with too much debt. Obviously you can default, you could restructure, i.e. haircut your investors to deal with it. I guess the other things you could do that are more palatable, if they were easier, everyone would be doing it, but you can increase your long-term growth rate, your productivity, and things like that. But also you can use financial repression as a tool to get effectively the interest rate that you pay on your debt down below the rate of growth in order to grow your way out of the problem. And I think that the conference talked about this quite a lot. Financial repression, the great example being the UK and the US and other countries, the Allies after World War II, managed to get their debt burdens down dramatically by effectively forcing banks to own government bonds and keeping the interest rates, the official interest rates, below the rates of inflation. So negative real yields help an economy deal with its debt burden. And I think that financial repression and allowing inflation to take control a little bit were seen as the most palatable ways and the most likely ways that all governments around the world going forwards will deal with these problems. And that's obviously, again, not an attractive outcome for bond investors if it is that inflation takes off in future years. So, how did people feel about the future of sovereign debt and its restructuring? Well, I think it was slightly gloomy. I think in the Western world, the rise of populism means that there's an expectation that the public will demand from right-wing parties tax cuts, meaning higher deficits, and from left-wing parties higher spending, meaning again higher deficits. So this trend that we've seen of stabilisation, as populism rises in the Western economies, then maybe that's under threat and we see a renewed rise in debt to GDP levels. And if interest rates and inflation rise too, then debt service costs start to rise as well. In emerging markets, I think there's a great deal of nervousness about some fragilities there. And I think that not just the rise in indebtedness in emerging markets that we've seen over the past 5 years or so, but also the fragility about the ownership. And, you know, for Japan, it's kind of okay that they've got a huge debt to GDP ratio because all of that debt is owed to its own population through the Campo and the postal banking saving systems. When you get to the emerging markets, if half your debt, or maybe not quite that much, is owned to foreigners, then they can be quite flighty and change their mind en masse about whether they want to lend to you, and you end up with financing crisis. You can't roll over your debt. And I think the panel also touched on the mutual fund industry as being large buyers of emerging market debt, and that is something that may not remain a constant buyer in the future and introduces more fragility to the system. I think another problem is in the default and restructuring process itself. There are so many ways that a country can go through this restructuring. There are, different rules, different legislations, and it's not like company defaults. We have Chapter 11, we have something called bankruptcy for companies. There's nothing of the sort for countries, and I think that was regarded as something that's missing very much in the world of sovereign defaults and makes restructuring that much harder. So a lot of uncertainty when it comes to sovereign debt and sovereign debt restructuring and default. But what's not uncertain is the way that sovereigns do go bust. And it's in line almost always, some exceptions and wars being one of those, but almost always in line with Hemingway's protagonist in The Sun Always Rises, that famous quote, "How'd you go bankrupt?" Bill asked. "Two ways," Mike said, "gradually and then suddenly." This is Jim Levis from M&G in Washington, DC.